All right, it looks like my clock just clicked 12. So we'll get going here. Again, a few folks here will enter the room here as we go through the next couple of minutes, and that's totally fine. My name is Jared Sebesta. I want to thank everybody for joining us today. I'm in charge of marketing and development here at Tejas Financial Group. I think a lot of folks on this call probably familiar with who we are and where we're located, but we are a retirement planning firm. We're based in Wilmer, Minnesota. We have 9 full-time staff and 5 licensed advisors. What we do is we build purposeful retirement plans. That's what we do. Our ideal clientele, 50s and 60-year-olds, people that have either just retired or planning to retire. That is certainly our bread and butter. We certainly welcome and offer services to people outside of those confines, but that is really what our business is specifically designed, that demographic, to serve, and I feel that we do that really well. Our website is simply tejasfinancial.com. My personal email is Jared. You can see the name, the spelling of my first name there, kind of below my picture. My email is jared@tejasfinancial.com. So again, those are kind of our quick little opening statements here. And if you need to email me outside of this, please do so. But again, thank you for joining us here today. Well, first things first, this is a purely informative seminar. Just take a deep breath, relax. We're not going to sell you anything today, which is kind of a rarity, especially when it comes to information on Social Security. Usually there's some sales pitch, and I promise you that is not coming. This is purely just a value add for you folks today. I promise we will not go longer than an hour. In fact, our goal is to wrap up a little bit before 1 o'clock. If you need to step outside the room, feel free to do so. You can pop in and out of the room as you wish. But again, I just kindly ask you that you keep your mics muted if you can. It's your choice. If you want to turn your video on or off, that's totally fine. However, if you have a question, feel free to put that in the chat. The bottom of your screen, if you're not familiar with Zoom, there's a little button that says chat. There's a little public chat room I'm going to be monitoring as we go throughout the seminar today. If you have a question, we've budgeted about 10 to 15 minutes at the end of this seminar to answer those questions. And if a question comes up and it's kind of pertinent to the subject at hand, I may interject that with Tim and see if we can't at least get every single question, if not answered, addressed in some way, shape, or form here as we go throughout the seminar today. So again, thank you for joining us. So let's get started. Again, we got a lot to cover and not a ton of time. I want to introduce Tim Mattern. He is a certified advisor from the National Social Security Association. Basically, Tim brings us a massive amount of wealth and knowledge, when it comes to this idea of Social Security. And for you folks on this call, where you're going to be thinking about how Social Security fits into your retirement plan, this guy can really help you answer those questions, and he is a massive asset to our team. So I want to introduce Tim Mattern. And Tim, first of all, let's just get right to it. How often does Social Security come up in your meetings, and how do you help people with their Social Security?
Yeah, thanks, Jared, for the introduction. And it comes up often. I would say, I think when we initially went down this road of should we get a National Social Security Advisor on the team? Yeah, we found that we have utilized it so much. Weekly, I meet with not only my clients, but obviously whether it's Claire, Ben, Matt, I meet with clients constantly to discuss their plan. I think to get down to it, as we look at it, and there's 4 stages of the process that we try to do at Tejas. First one, just an initial meeting, just to get to understand your situation, to understand any factors that might lie into a decision as far as what should we do for Social Security, what does income look like, what does retirement look like, these types of things. So just an initial meeting to better understand you. The second piece of that is for those of you guys that are in your 50s, you probably don't get Social Security statements anymore. So what we want to do is actually sign up for what we call My Social Security. And we use this not only to get updated statements, but for the application process, which I'll get to. So I sit with clients, help them set up, or I should say non-clients too, help them set up their My Social Security account. Takes 15 minutes per person, but they ask you some information, want to make sure we have that. Once we've created the account, we have new statements, new information, then I started running some scenarios and start planning. I do some behind the scenes work, just bring some options to the table, and then sit across the table from the individual and say, hey, what works best? What makes sense for your life? Should we take it at 62 for retirement age, 70 or somewhere in between. And then once we've made that decision, and you can make that decision at 62 and it could change, but the final piece is actually the application process. And so I sit down again here at our office and actually do an online application. So as opposed to going to a Social Security office, either in Marshall or in St. Cloud, if you're in the Wilmer area, if you're out of state, your office could be an hour or two away. Here we'll actually sit down, do the application process. And I do want to remind people, when you go to apply or when you go to an office, they are there to simply help you apply. They are not there to help you run scenarios, figure out what's best for you. They're there. Their goal, it's a standard, is a 7-minute per client time frame. So it's super important to know that we will sit down, we will help you plan this out, because it's very important and it's a big factor into your retirement. And then we'll actually help you apply. So if you go down to Social Security office, you're not going to get help on when to apply. You are there to simply apply.
No. And again, I think you kind of covered the gamut as to what you do. I think it's really important that people hear that. It's a big decision, and I think it takes a lot of methodical planning well before you make that decision. And that decision is not to be made in line at the Social Security office. With all due respect, that's not their job. But make sure that you have the planning involved. So I think that's a great setup. We're going to spend some time and just get some general information down regarding Social Security, and then we're going to get a little bit more granular here as we go throughout the seminar. First question: how do you qualify, Tim, for Social Security?
Yeah, and I'll share my screen so you guys can see. This is a PDF, and I would recommend, if you guys can see it, that everyone maybe take a look at. It's MFS is the company, but I've referenced this quite a bit in my meetings. I print them out. It's a fantastic guide to really bring together some nuances, and there's a lot of information. I'm not going to go page by page. I'm just going to hit some highlights. And Jared said the biggest thing is, how do you apply? And so I'm just going to go through this, and there's two pieces, or how do you qualify? There's two pieces to it. The first is the very top, right in. So you need to have 40 credits or 40 quarters is what they call it. And so that equals to 10 years of working experience. So every year you can earn up to 4 credits. And so after 10 years of work, and if you obviously hit some income limitations, you technically qualify to receive Social Security. Now, how do they get the amount? Well, what we do is we take your top 35 year and we average those out to then give you an amount. And this is not a real Social Security. You can see Wanda Worker. This is not an actual client. This is something I got on the website. But if you are familiar with your statement, you can see that each year it shows your earnings. So what we're looking at is your highest 35 years. And I want to point out something specific that you can see here in 1985. This individual earned $9,000. Well, clearly 52,000 is more than 9. So that would tick off if you were to continue to earn more than that amount. But they do Social Security. They have a algorithm, and they actually index for inflation. So you might see 7,000, 9,000, 10,000. These are all indexed for inflation so that they are acting like they are in today's dollars. So we may see smaller amounts, but behind the scenes, when it comes to how much will my benefit be, they're indexing these for higher amounts. So if you are getting, if you're in your highest earning years and you're 55, 56, the next 6, 7, 8, 9 years could be very valuable to see your benefit increase. If you're working less, you're starting to go part-time, some of these years back in 84, even though it's $77,000, you might actually stay on to calculate your benefit. So that's essentially what they're looking for, is make sure you get your 10 years of earnings or your 10 years of work, and then let's look at your earnings. And we're going to take your top 35 years and average those out.
We've had a couple of people join our room since we started. I just want to remind everybody, if you have a question, feel free to use the chat feature. Click on the chat. It's at the bottom of your screen. Type in your question. I'll keep track of these as we go along. And again, we budgeted some time at the end of this where we can, at the very least, address hopefully every question that gets asked here today. So Tim, let's talk about some very simple acronyms, some jargon regarding Social Security. You've already mentioned one: full retirement age, or FRA, and PIA. Yep. Let's talk about those things.
Yeah. So those are the two most common ones that I think at a high level people should just generally understand. So You just mentioned it right there, FRA. We use it all the time. In our term, that's the year that you turn your full retirement age. Now, that's based on the year that you were born. So you're born 1943 to 1954, you're at 66. And so many of you have seen, well, I'm born in 55, you're at 66 in 2 months, 56, 66 in 4 months, and so on. Now, if you're born 1960, you have officially at the age of 67, that's when you reach your full retirement age, okay? Now that goes in line with something very important that we like to, that is called your primary insurance amount. That's the amount that you will get once you achieve your full retirement age. The reason why I don't utilize the term FRA and say this is the amount you get at your full retirement age, because when it comes to PIA, that's the amount when we look at spousal benefits, when we look at survivor benefits, when we look at widower benefits, when we look at divorce benefits, all these other types of benefits out there, we need to make sure we're referring to the PIA, which is the amount that you receive when you turn your full retirement age. So I try to be very specific about making sure we know the difference on them, and don't think, oh, PIA equals FRA. No, two different things. They're very important to keep separate. Again, these are things that we discuss in our meetings, but it's good for you guys to know.
Good follow-up question here. How does your age affect your Social Security benefit? And then we got a question already. It has to do with phase out with terms of earnings. And we're going to get that. So just hang on a second, Ross. But let's talk about first, how does your age affect your Social Security benefit?
Yeah, so that's the biggest thing. And so if you're looking at the screen, we have on the left-hand side, this is if your full retirement age is age 66, which means you'd be born in 1955 or 54 before. On the right-hand side, full retirement age of age 67. So considering the majority of people probably on this call are going to have a full retirement age closer to 67 or somewhere in between, I'll focus in on there. So at age 67, you get that full retirement age amount, which I'm going to go back to the Social Security statement. This is all on there. And I think it's amazing how many times people are like, I really don't understand how to read this. So I think it's important to highlight some of these pieces. But on everyone's statement, you'll see 3 different amounts. You have your age 62, okay? Then you have your full retirement age of 67, what that would be of 2,061 for this individual. And then you have your age 70 if you were to delay taking Social Security of 2,561. So those are the numbers that in our head, okay, 2,061 is what I would get at age 67, my full retirement age. Let's piggyback, or let's go back to this chart. 67 is that full amount. So if you take it prior, age 66, you will then lose 6.7% of your benefit. And that's for your life. And then at age 65, 13%. And you can see the earlier, the sooner you begin to take your benefits, the more that you will actually give away or you won't have for Social Security or for your benefits. So at age 62, if your full retirement age is 67, you will have 30% less. And that's what this is showing you at age 62. You're down over 30% that's $600 per month that you're potentially giving up. I'm not saying that you don't need to do it. Again, it's just proper planning, and let's take a look at it. But sometimes people say, well, let's just take it at 62. Let's just take it at 70. No, let's plan for it and see what works best, because $600 a month is $7,200 a year. That's a lot of money you're leaving on the table. If it works for your situation, that's fine. But specific to this, it's not a clear cut, hey, take it at 62. There's more to it.
So your quick follow-up question from me, you can answer this very quickly. Yeah. You have to start taking it at 70, or does it platform at 70 and just steady off, or what? How's that work?
Yeah, for sure. So if we were to wait, at 70 is the max you can hold off. So there's no reason to wait past that. Gotcha. I just had a client come in the other day. They did not begin their benefits at age 70. They did not actually apply. I think it was 3 or 4 months later. Social Security went in and actually back paid them for the okay. month that they missed. So if you do wait and you say, you know what, I'm still working, I don't necessarily need this income right now. Well, if you wait a year, 8%. If you wait 2 years at 69, 16, and at 70, you could potentially have 24% more of a benefit. And that at age 66 is even better at 32. One piece that I really and I'll stop this, but one piece that I really want to, get to is clients will say, well, why not just start? Why not wait? Because you're guaranteed to get 8% per year. And I agree with that to a certain extent, to say it's hard for us as, and I'm not going to throw us under the boat, to guarantee investment 8% a year. I get that. I would also then argue and say that may make sense, but what you can't do is you can't pass on your Social Security benefit to future generations or inheritance. So maybe we begin taking Social Security, spending the government's money. I found out it's much easier to spend the government's money than it is your own. And also your 401k, your IRAs, your Roth IRAs, that can get passed on to future generations and can be used for other ways. So I like the idea of guaranteed 8% growth, but you can't pass it on. Something to consider.
Good point. Good point. Got two questions we're going to fire at you. The next question, we're going to talk about income limits. This is a very important concept when it comes to full retirement age.
Yep.
Discuss that, but if you can address Ross Larson's question. He said, is there a point of phase out or maximum in terms of earnings? I think that these two questions go together. If they do, try to connect them if you can. If not,
I might need, and I might need clarity on Ross there specifically, but I'll get into the earnings piece and what it all comes into play. So, back on, we are going to, so here's the specifics and maybe what Ross was alluding to, but prior to your full retirement age, there is limits to what you can earn as far as Social Security as far as Social Security is concerned. So if you are age 62 and prior to your full retirement age, this is a number that we discuss a lot with our clients. That's the amount that you can earn. Now that number gradually goes up. Last year it was 17,004, I think 420. So that number is 18,960. So if you say, Tim, I want to begin taking my benefits, the first thing I'm going to ask is, how much are you going to earn? If you say less than 18,960, I'm not concerned. And I say, okay, we can continue to go down that road. If you say I'm going to earn 40,000, I'm going to look at you and say, we should probably rethink this. So what happens is if you are above this $18,960 limit, Social Security will withhold $1 for every $2 of earnings above that. So I'll explain that a little bit. So let's assume you earned $5,000 above that. So just shy of $25,000. If you earn $5,000 above that, they're going to withhold $2,500 from your benefit. That's each month. So that's $220 a month potentially that they're going to withhold from your benefit every single month. Now they call it a haircut. That's a term that we use often because they basically bring down your benefit for the years while you're working prior to your full retirement age, and that money actually gets put back into your benefit. But the difference is instead of what you have withheld for the last 4 years, is they're going to expand it out and include that into your benefit over the next 30 years, or basically till the life expectancy. So for you to say, you know what, I'm going to earn $25,000 or $30,000, well, we're going to see a significant amount with money withheld from your benefit. I would probably rethink that. But if you're below the 18,960, then it could make sense for you to begin taking a benefit. So that's the for sure one thing if you're 62, 63, 64 that we need to consider.
Okay.
The second piece of that is this other number is in the year turning your full retirement age, you can earn $50,520. So we start to see that number bump up. It allows you to earn more, allows you to work. Once you turn full retirement age, this is important, is then you can earn whatever you want. So if you have a birthday in February, you can basically earn $50,000 in 1 month because once you turn your full retirement age, you can earn as much as you want. Taxation is a different thing. We'll get into it. But if you have a December birthday, you can only earn $50,000 that year. So it depends on when your birthday is, but that year, that's the number we're going to look at. So you get to see it spike up a little bit more. And this is where people tend to begin their benefits because they're, they aren't making the $50,000, but that's another piece that we want to look at. And then the difference here, instead of $2 of earnings, for every $1 you make, or for every $3, above that amount, they'll withhold $1. So if you earn $6,000, they'll withhold 2 instead of 3,000 up here because it's a 50%. So they'll withhold about 33% of your earnings from Social Security.
And I'm correct me if I'm wrong, Ross, and feel free to jump in here via text and clarify.
Yeah.
Is there a point, Tim, where all these limits go away and it doesn't matter how much you make, and you're not quote unquote not penalized, but they're not they're not haircutting it out?
Full retirement age. The day you turn your full retirement age, whether it's 60, 62 months or 67 on your birthday, these limits go away. Taxation, different story, but not penalized or anything like that. That would go away. Yep.
Ross, if that's the end, let us know if we've answered that question sufficiently. If not, clarify a little bit more in the chat. Next question. What other types of benefits are available for Social Security?
Yeah, and I will, and I'm going to just jump around real quick, but I think the biggest one that we talk about and the one that people should know is spousal benefit, because that affects not only married, but someone who didn't work necessarily. For instance, my mom, stay-at-home mom, took care of us. So her Social Security statement, very small. So this is important. So if you, again, I'm going to highlight the age 67. So assuming that a spouse did not work, you can then collect benefits from the main income earner. And so this is a great option for those that are in that situation. So if you take it at your full retirement age, I'm saying the spouse, you could receive up to a full 50% of their benefits. So someone whose spouse earns, their benefits $2,500 a month, you would get $1,250 guaranteed for the rest of your life. Okay. If something were to happen to your spouse, you would kick up and get their full benefit. But for the time being, you would get a full 50%. So let's say you're 66 or 65 or 64, and you want to start collecting off your spouse, you can. But again, Social Security says, well, we're going to withhold a little bit more. So at 66, it goes down to 45%, 65, 41. If you, again, full retirement age is 67, if you say, I'm going to take spousal benefits at 62, you would receive 32.5% of their benefit. So is it a wise decision? Again, it's situational. It's what makes the most sense. There's a few requirements that I do want to highlight on this is you must be currently married, and it has to be at least 1 year of marriage, or you need to be divorced for 10. But the second is your spouse must be receiving their retirement benefit or disability benefit. So a few years ago, we used to be able to do a file and suspend. You would hear maybe some of your parents have done this, or a restricted application. The restricted application is the only caveat that's still available, but you have to be born before 1954. So if you're not born before 1954 and you're born 55 or 56, there's really no unique filing ways to go about it. It's pretty straightforward. Your spouse has to be receiving their benefit, and then you can all of a sudden jump on. And this is, again, available even if you didn't work. The second piece is if both you guys worked. Generally, you receive the greater of your retirement. So for the situation I was just talking about, if your spouse's benefits $2,500 per month, and your benefit is $1,000, you could be eligible for what we call a spousal boost of, if you waited till full retirement age, you got a full 50%, you can be eligible for spousal boost of $250 per month. So it's $1,000 right away, but you would get, again, a little bit more. So if you both did work. And then the biggest thing is only one spouse can receive a spousal benefit. So your spouse can't wait and claim off of yours and then hop on theirs. It doesn't work that way. Only one spouse can be receiving a benefit at a time.
We've got about 5 minutes left that I want to cover some general information. I have a question for you, Tim, about tax. Ross jumped back in. He said, in terms of benefits, for example, if for 20 years you make 50 to 90K, and then the last 10 years of your career you make 200K, when they calculate the benefit, do they cap out the 200K at some level, or is the benefit uncapped? Yep.
Nope, they do cap it. There is a benefit. You can see maximum. I'll answer that in 2 parts. So it's every person, there's a limit of what Social Security considers taxable earnings. So if you earn over 142,800, none of that money goes into the Social Security pot. So there is a limit to how much is going to go in there. So if you're earning 80 or 90 or 100 grand a year, all that has a tax of the 6.2%. It's the FICA tax, right? The Social Security tax that goes into help out your benefits. So there's a limit. So if you earn $500,000, only $142,000 is actually being is actually going towards your benefit. And so you can see there's an actual maximum amount of benefit that you could achieve. So assume, again, this number continues to go up with inflation. Last year was 139, next year will be 144. This number will continue to go, but if you have always maxed out the Social Security taxable earnings limit, this is the highest amount you could receive at full retirement age. Now this can grow by 8% per year, so it could be 3,500 or 36, but math tells us, okay, 142,000 goes in. The most that you can get out of Social Security is 3,148. So yes, they do limit that, if that answers the question.
Yep, Ross gave us the thumbs up, so we appreciate that. Again, for anybody that just popped on the call, if you have questions, feel free to put those in the group chat, and we'll try to address them here as we go. I want to get this question answered here in the next just couple of minutes. Let's talk about taxes, Tim. I know this is a big part of it.
Yep.
A lot of different scenarios. Let's cover that.
Yeah, I will go over this on page 27. So I think here's, again, everyone's used to looking at tax brackets. Well, Social Security is the same thing. The term we're looking at though, right here, combined income. That's the biggest piece that I want to highlight. And so what is combined income? This will tell us. If you take your AGI and then you include any non-taxable interest. So if you have investments that are non-taxable, they will include that into this calculation. And then they take half your Social Security. So if you're making $2,500 a month, which is $30,000 a year, you would include $15,000 a year into your combined income. So if you're fully retired, are not doing any sort of part-time work, so our AGI is 0. We don't have much for interest coming in as far as investments, and we're just Social Security, you will not be taxed. They have it in the formula where you will not have taxation. It's for those that have some sort of side income that are part-time work, or just if your AGI is, if you actually have some sort of W-2 wages coming in, then you could pay tax. So we have our combined income. Now, will it be taxed? Well, if it's less than $32,000, married, filing, and jointly, no, you will not pay any tax. If we start to creep up and we have outside income coming in, up to 50% of your benefit could be taxed. So 32,000 would be 0, and then it increases, and once you hit 44,000, up to 50% would be taxed. And then the final bracket is you could pay anywhere from 50 up to 85% of your benefit taxed if you earn more than 44,000. This isn't 85,000. This is not an 85% tax. This is of your benefit, 85% of that benefit would be subject to your ordinary income tax. So it's something I want to make sure is clear on.
No, because it's not just as simple as it's tax or not tax. There's a number of tiers and then brackets that it falls into.
Exactly.
Okay, great. Let's move on to the next part of this. Let's get into some different scenarios. One of the biggest questions you get, Tim, I think has to do a lot with when should I file? I mean, I think that at the end of the day, that's kind of what it all boils down to, is when should I file? We've got 5 reasons why you should actually wait longer, or at least wait to file for Social Security. Let's run through these, and I think hopefully this will add a lot of value, because I think probably everybody on this call, you'll start to maybe take a nugget or two that applies to your personal situation.
Yeah, for sure. The first one is if you plan to work, and we highlighted this prior, but this comes into that income limit of $18,960. So if you're expecting to earn more than that $18,960, it would probably make sense for you to hold off and wait, just because Social Security will withhold $1 for every $2 of income over that amount. So that can be hefty. If you earn 20 grand, maybe we look at it and say, hey, it might make sense because you could use the extra income. But if you're substantially above that 18,960, probably makes sense to wait.
And when you say wait, are we mainly talking from 62 to full retirement age, or just waiting in general? I know there's a definite cusp, there's a definite turning point when you turn full retirement age. Are you talking waiting beyond even full retirement age, or is that kind of generally how you're looking at this, or just waiting until full retirement age?
Or even sooner too. I mean, if let's say you plan to work till 64 and then you're going to be done, we might take it at 64. So it could be even beyond it too. I mean, you could take it at 67, 68 for sure. But yeah, I don't want to say wait from 62 indefinite. Now we wait. Now we take it at full retirement age. It might be 64, it might be 65. It all depends on where your life is, where your situation, what you plan to do. So if you're looking to retire and Medicare, for instance, your Social Security or your full retirement age 67, and you're like, hey, I need to continue to work to get health benefits till age 65. Perfect. Maybe that's when you retire, and that's when we kick in Social Security. I've had that happen. That's very common, I would say, because one of the hardest things for people trying to retire early is, okay, Social Security, but what are you going to do about health insurance? And if they don't have COBRA or something, that definitely plays a factor into that. So
that's good. That's good. What's number 2?
You have little savings. And I want to say you have little savings mean you're single, you're healthy, and it might just make sense for you to hold off on taking Social Security, because what we're trying to do is build up guaranteed income. And I think that's important, because this benefit, again, it goes on for the rest of your life. So if you don't have a lot in savings, and it might be advantageous to say, I'm going to continue to work a little bit longer, and then I'm going to pull a higher benefit for the rest of my life, as opposed to, let's get this thing going now. If we can hold off on it and build this up, again, potentially 8% a year, it's a nice benefit boost for the rest of your life.
But I'm sure it comes down to calculations. It comes down to those income limits. It comes down to taxes. So it's not just as simple as I'm going to keep working until I'm 70 or beyond.
Exactly.
There's some mathematical equation, so to speak, that need to come into play.
There's many factors out there for sure.
Yeah. Number 3 is what?
So your spouse is working. I think that's a main thing where we want to look at and say, okay, my spouse is continuing to work. Should I take mine? And if we can, again, build up your benefit, it could make sense. And remember, the higher combined income means you could be taxed more. So you got your spouse working, all of a sudden you might not be working, but you guys are married finally jointly. Does it make sense from a taxation standpoint? And that's a piece that, again, if we can hold off, I would recommend that we look at that. Again, it builds up a higher amount for you, and potentially a higher, remember the spousal benefit decreases too. So maybe you hold off on it and say, hey, I can guarantee 50% at my full retirement age. So if we want to, and your spouse is continuing to work, it could make sense to wait.
Just another reminder, if you got questions here as we go along, feel free to put those in the general chat, and we'll try to answer those here as we go along. We got 5 things that we are talking about, reasons to wait. What's number 4?
You expect to have a long life. And I know that's a tough one. That's a crystal ball. As we say, if you tell me the day you die, I can tell you exactly when to file. But we can look at things that are known. You look at, your family, you look at bloodlines, how is there disease in the family, or are you guys relatively healthy? And if family's healthy and parents and grandparents have lived in their 90s and beyond, and granted, we don't know what life can happen, but if that's the case, it's worth a conversation. I mean, I think that's important that we actually discuss that and say, what's a reasonable time frame that you could expect to live? Could be tomorrow, we get that, but you get what I'm trying to go after.
Well, two things. Generally, if you make it to 65, statistically speaking, there's a good chance you're going to make it into your 80s, statistically speaking.
Yep.
I think to reiterate your point, and this will come on the other side of this conversation when we talk about reasons not to wait, you might want to take the benefit now, because you can get that money into a retirement vehicle, and then it can be passed on to heirs.
Correct.
So I'm guessing that's part of the flip side of this conversation as well. But again, that needs to be considerations. But it's probably not the most fun conversation to have with folks talking about their life expectancy, but you have to take it into consideration.
We have to be honest and talk about it.
Yep. This last one here, you talked about, we've talked about this one on the radio show before, and you said this is a really, really important one, maybe one of the most important ones out of this list.
Yeah. So, and that is your spouse's benefit is smaller, or your spouse is considerably younger. That's where we see this come into play. If there's, specifically if it's 10 years, if you're, 65 and your spouse is 55, we kind of call this the life insurance policy, or the life insurance benefit, because what we're trying to do And I'm guessing that most spouses would say, I want there to be a larger benefit for them. So if they didn't work or they have a small benefit and you have a large benefit and they're 10 years younger, maybe we'll wait until age 70 to lock in that maximum benefit so that if or when something happens, then that spouse can lock in that 100% guaranteed benefit. That I think is super important, because if you can take a $2,500 benefit and turn it into $3,100, if you can financially afford it, and then something happens, well, your spouse gets that full 100% amount. So I think that's super important to look at. If there's a big age gap between them, then I think it's something that for sure we discuss. And I'm working with a set of clients right now, and that's important. He wants to make sure that his wife is taken care of, and I'm like, I get that. He wants to lock in the highest amount possible. So we're waiting until age 70, and that's what's important to him. It might not be mathematically what's the best for their situation, but to him that's important. That can override some of those numbers sometimes.
That's interesting. Let's move on now to reasons that you should not wait. Again, I think the general piece of advice that lots of people may get is if you don't need it, don't take it. But
Yep.
There are instances where it would make sense to perhaps file right away or early,
Yep.
or both. Let's go through those.
Yeah, and it's the flip side of what we just talked about, is you don't expect to earn over that income limit of 18,960, and you can use the extra income. I think that's the first answer, or the first question I always ask is, are you going to make that? And if the answer is no, I think it could make sense for you to begin taking benefits, because you're getting a lot extra years of benefits coming in that could definitely help you out.
Mm-hmm. Second one talks about our health. Again, it's kind of the flip side of the last couple of minutes.
Yep. If you know that, well, either life expectancy in the family, or else if you know that you have some sort of illness or disease, I mean, those are, again, not fun conversations, but things that we're trying to plan out for you, for your future, for your family, for your kids. And so bringing those to the table, and if there's something that we know about and life expectancy is shortened, maybe we should start taking this benefit and start collecting, and maybe you retire sooner because of it. That's another piece is, you know what, I not only begin your benefits sooner, but hey, stop working and start traveling and use what time you have with your family if it's something that could be terminal. So definitely worth the conversation.
Wow. Yeah, that's a good point. I hadn't thought about that.
Yeah.
Number 3 is you lack other income sources and have no opportunity to earn money.
Yeah. And
pretty straightforward.
You just got to turn it on, and you'd be surprised. I think the stat is like 72% of people begin their benefit at age 62. So majority of Americans don't wait till full retirement age. They don't wait until 70. They take it at 62. They get there, they just start collecting. Whether or not they know the income limitation, I don't know. But it's kind of like, hey, I'm 62. I've been waiting all this time. Like, let's start getting government's money. I get it. I understand it. Let's at least plan for it first and make sure it's best for your situation.
We come from a little bit of a younger generation, Tim. I mean, when we started talking about Social Security in our generation, probably, the generation that came after a lot of the folks that are on this call, our question is it going to be there? Mm-hmm. Is that question getting asked from people that are looking to file? I mean, is that still a concern?
All the time. I get it. I mean, we host live seminars, and I wish we could do, and we'll get back to it. But that's one of the questions that comes up, and the answer is yes. I think it will be there. People are like, well, we're spending all this money, and I get that. But the Social Security Administration will do a few things, and I'll highlight 3 that I see. They'll continue to increase FRA, or full retirement age. So Jared, you, me, younger generations, it ain't going to be 67. It ain't going to be 68. It might be 69. It might be 70. But that's fine. We're going to be, if you look at our healthcare system and where we're going, people are living longer. We're probably going to be working later in life. So for them to up it a few years, it's going to happen. So I think that's one piece you'll see continue to come down the pipeline. They'll continue to increase the amount that goes into Social Security. That's that 142,000. That number continues to go up, which means more funds go into Social Security, into the system. So that will continue to keep it, keep it solvent and keep it available. And then the last one is someone who's retired and has worked hard, which is great, but they have income of whether it's 200 or 500 or $1,000,000 a year, they're getting Social Security. So, and I'm not, that's fine. But I would say that at some point they're going to say, okay, you're making in retirement, you're 75, you're making $1,000,000 a year from outside sources. Nice job. You're not going to get Social Security. So I would feel like they will start capping it. It'll probably be a higher amount, but eventually you can see where they say, you know what, if you're making 500 grand that for the foreseeable future in retirement, you don't need a $2,500 check. So right, wrong, and different, those are some of the things that I would say that we would probably see down the road.
But for people who are on this call who are, again, 60, give or take a few years, a reason to take it early should not be because I'm guessing in the future it might be there. They're going to cap it at my income level.
No, not at all. I would not be concerned at all for anyone their age, maybe younger generations our age, but no, someone 50, 60 is not able to be there. I'm confident.
Okay. Great. What's number 4?
Number 4. I think this is one, even though you have smaller checks, and I got into this a little bit, you will have received potentially 8 more years of checks. So you start at 62, and if you would have waited till 70, yes, your benefit's higher, but you ultimately could have been receiving Social Security this whole time. And again, for the right person, it makes sense. So the most common thing is if you start at 62 versus 60, your forward retirement age 67, roughly the break even is about 12 to 14 years, depending on the amount. So if you take it at 67 and you live past, at that point, it would have been 89. At 62, if you would have taken it, and if you make it to basically, it'd be 79, then you should have waited in theory because your benefit would be higher because the amount of benefits at your forward retirement age is higher. So that's probably the biggest thing is you can start collecting checks, start spending the government's money. However, the break-even time, again, 12 to 14 years on it.
But to say that one more time. If you're 62, considering taking it now because you want to get your money now, so I can get a little less checks but more money sooner.
Yeah.
The break-even point on longevity is 79.
Yeah, give or take.
Give or take. So, again, we're splitting hairs at this point, but if you could in theory say if I plan on living on longer than 79, I may want to hold on to it.
Correct. And again, it's a numbers thing, not necessarily a lifestyle. That's completely, and that's why it's hard to go down that route because I think it's got to fit your lifestyle as far as
you're turning longevity and life into a mathematical equation, which is not.
Yep. Nope. More to it, to say the least.
Yeah. Well, that's an interesting algorithm. Number 5, pretty straightforward. Go for it.
Yeah. More people choose to start collecting at 62 than any other time, so it's not uncommon. And I would think that the majority of those people, not saying they don't need it at 62, I would say it's because of lack of planning, lack of sitting down with somebody. I'm 62, I'm going to the Social Security office and I'm signing up. So good, bad, and different, it is what it is. I think it's super important that you do take time, that you do speak with somebody. Just like you look at your retirement plan and you meet with your advisor, this is the same situation. This is a major, we discussed it. It's it could be 30, 40% of your retirement income can come from Social Security. So you can only make you can only take back applying Social Security once within 12 months. After that, it's a lifelong commitment. So make sure you do it right.
Just re-explain that to people because that's important.
Yeah.
We talk about how this is a kind of you get a one-time shot at doing this, but that's not true. You do have a 12-month window to change it, but there's some ramifications of that. Just speak into that really quickly.
Yeah. So if you begin your benefit and 6 months in, let's say you go back to work, your lifestyle has changed. You said, you know what, I don't necessarily need it. I want to wait and let my benefit continue to grow. You can do it. You have 12 months within your application date to actually go back and retract that. The caveat is whatever benefits you've received, you have to pay back. So if you've gotten 6 or 7 months worth of benefits and that's, $2,000 a pop, well, you got to be prepared to give that back to Social Security. So yes, it can be undone. Just you don't want to do
you don't want to do
it. And if if you're going back and you found a career and you found a job that makes sense and you enjoy and you love it, then we got to do what we got to do. But it's not the ideal situation, to say the least.
Okay, got it. If anybody out there has any questions, feel free to add that into the chat. I'll give everybody just a couple more moments to ask a question in the chat room, and maybe if we have time here, we can just maybe even unmute your mic and you can ask that question live if you wish, but let's use the chat room to utilize that. As I'm giving everybody just a couple of minutes here to do that, Tim, just talk about if people wanted more questions, if people wanted to get in and talk about this more, what is that? What does the kind of our process look like? Again, from a non-client perspective, I know we have some clients on this call, but for folks who don't work with us, what's the process look like?
Yeah, first off, there's no cost to it. We're not looking at, we're just trying to help. So there's no cost for anyone who's not a client. And for our clients, it's just included. It's what we do. So you can either, number one, email me questions or give us a call, but I would recommend just setting up a meeting. Give us a call, take a half hour, take an hour. I want to respect your time, but sit down and start having some conversations specific to your guys' plans, what you want to do and what retirement looks like. And then we can begin to plan this out. So I think the first thing is, again, get a meeting schedule, discuss your situation. Second one that I talked about was getting a My Social Security account created. Again, if you're in your 50s, you haven't received statements, you get those annually when you turn 60 in the mail. But I like to have up-to-date ones. Most people come in here and they give me a statement from 5 years ago or something, some old one, which is fine, but I would rather have accurate, up-to-date numbers. So getting that online account created, I think is critical as far as planning and accurately planning. And then the third piece of that is actually let me run some scenarios, let me bring it to the table and say, here's what I think could be best for your situation, what makes sense. And I've had people where we have started a plan 2 years ago and we were set on it and life changed. And then the good thing is we can change it and adapt as needed. It's a fluid and liquid situation and a liquid plan. So don't feel like once we decide like, oh, now you're stuck in it. Not at all. Life does happen. So we can adapt like anything else. But the good thing is you have someone across the table that you can bounce ideas off. You can discuss certain situations, even if they're hypothetical. Like that's what we're here for. To really analyze what would be best for you and for your family. And then obviously the last part of that is we want to help out with the application process. For those locally, again, you're going up to St. Cloud, you're going down to Marshall potentially, and you're in and out. You're not there to sit to actually have some guidance. So we help with the application process. It takes me, like I said, 15 minutes, pretty quick and painless, and then you're done. So I think our clients and people who are not our clients who have used our services are happy and pleased with it. I think it's a great value add to you guys and in our area. Why not use it? So
great stuff, Tim. I don't see any other questions in the chat. One last call for any questions in the chat. I see a few of you have your cameras on. I'll just give you one last chance here. Maybe do a hand raise if you happen to have a question. Otherwise, we'll start to kind of just wrap this up. I promise that this would not take an hour, and it looks like we're going to hold fast to that. One last call. We'll leave it there. If you want to get hold of Tim and have specific questions for him, please give us a call. Our number is 320-222-4236. You probably know where our website is. That's maybe how you found us and found this seminar. It's teachusfinancial.com. And if you are looking for more in-depth help on this, again, whether you're a client or somebody who doesn't do business with us, we highly recommend you reach out to us because we've got people that can help, and certainly Tim is a major asset when it comes to Social Security. So Tim, thank you very much. We appreciate that. We thank everybody for joining the call here today. Again, if you have more questions, please reach out to us. We'd be glad to help. But for right now, we'll see you. Have a great day. Enjoy the rest of your week.
Thanks.